Hi, and welcome to the Build and Exit podcast. I'm Judy Wilkinson. I'm the owner and founder of Wilkinson Accounting Solutions, and I started the podcast off the back of the work that we do in the company because we found there was a big gap in business and acquisitions where owners and investors were struggling with financial literacy. So I'm really excited today to have Marc Adams with me. Hi, Marc.
Hello, how are you? Thank you for having me. I'm really excited to be here.
Oh, it's lovely to have you. Marc is a very interesting entrepreneur and has successfully written a book, which we'll talk a little bit about, because he sort of focuses on 10x in cash received in your business, although the book's called something slightly different. So a bit of background about Marc and why I've sort of chosen to bring him on the podcast is because I think he can bring a lot of value. Is Marc works with businesses. He's got 6 businesses currently that he's working with. They range averagely between sort of 3.5 and 80 million, although he has got a large one that he's working with of 800 billion. And Marc will sort of go into how he helps with this 10x in businesses' wealth, essentially. And so I think there's going to be a lot of value you can bring to the table, Marc. So first of all, I just want to thank you for coming on and hand over to you to give a bit of background why you wanted to come on the podcast.
Well, first of all, I'd like to say I'm excited to be here and thank you for having me. That's a very nice introduction. Thank you. Not many people describe me as interesting, but so I'll take that one on the chin as a feather in my cap. Who's Marc Adams? So I've spent nearly 4 decades split pretty much 50-50 between being an entrepreneur and also working in corporate. So I started years ago in telesales, then management, then marketing management, then running regions, then running bigger regions, then, and sort of moved up to sort of VP, senior VP, CEO positions, mainly in the tech and financial services space, running P&Ls for companies like Thomson Reuters of between 30 and 80 million dollars per annum. 30 is where we started, and that's where we ended it. And and other companies like that. But then there was kind of a nirvana moment where I transitioned by accident into acquisitions. And so I've spent quite a lot of time in there as an investor in the SME sector, which for me is probably up to 35 million. I like to say 50 million in revenue, but the reality is most of the clients that we work with are in the sort of 3 to 20 or 3 to 18 space. There are some outliers, as you mentioned. We've got a big one in the portfolio. But what I've found as an investor trying to buy a business is that, number one, sadly, 9 out of 10 companies, and this is a well-known figure that people talk about, that come to market within a year haven't sold, within a year and a half haven't sold. And you can think of that as a little bit like an estate agent's, where if you're overpriced as a property that you're trying to sell, it's going to stick on the market. If you're underpriced, it sells in a day. If you're correctly priced, it's 3 to 6 months, it's done. And so businesses are quite similar to that. And so when we got to a point a few years ago where we had 93 companies in a pipeline, meaning companies we'd like to do more with, that we'd like to invest in or acquire, but we couldn't. It was because predominantly the price that an owner wanted for the business was absolutely way and above, over and above what the market would say that it was worth. Now, I'm not saying it isn't worth it, because if you reflect the blood, sweat, years and tears that these people put into their companies, their brand, their reputation, and the care that they've put into building their life's work, in many cases, then you'd probably argue that it's a fair price. But when you look at the economics of it as to how it's cash flowing and if it's making a profit, it becomes quite a difficult conversation. So what private equity does and what we did was wait. And either the company comes off the market at some point in time or the price comes down, and then people start talking about it. But my son, he was 10. So I try and get my kids involved in entrepreneurship because I want them to run their own companies. So he said to me one day, well, and I was explaining this problem. And he said, well, why aren't you working with the 9 out of 10 companies that aren't going to sell, Dad? And I said, well, because they're quite expensive. He said, yeah, but they need help more than the ones that are going to sell, because how are they going to look after their families and so on and so forth? Now, this is the mindset of a 10-year-old, and I sat there and thought, got a point. How would you do this? And that was the beginning of Secrets to 10xing Your Business and Cashing Out Tax-Free, which is the book that I recently wrote, and it's now on Amazon and Audible. So I wanted to make that book available to as many people as I could with 12 chapters of easy reading, of tips and tricks that you could follow through on yourself without any help from me or anyone else to try and improve the value of your business so that you were in a position to put 10x the amount that you were going to get according to what the market says you're worth in the 9 out of 10 companies in your bank account. So the title's a little bit misleading because it talks about 10xing the value of a business, but really what we're about is 10xing the value that could go to your bank. And that's a 3-step process. It's improving the value of the business, which I know you do a lot of work to help people on. It's also about how would you go about selling the business without having to pay any tax or paying very minimal tax, which you can do in the UK and in the US. You're very familiar yourself, Julie, with some of the ways in which you can do that. But once you've done that, how do you then protect that legacy for your loved ones and put it in a position where you have a better chance of that legacy growing than maybe let's imagine that you left $500,000 to one of your children. They were very grateful for that. They put it into a property, they get married, but sadly it ends in a separation or a divorce. Then half of that asset that you've worked hard as a family to build to get to that point, then you sort of disappears in a divorce settlement. So, and I'm not saying that's a good example, but it illustrates the point of of the 3-step process. You've got to improve the value, you've got to exit in a way which is incredibly tax efficient, and you've got to look after the legacy going forward so that you can enjoy that in your retirement and your family can enjoy it for years to come. So that was the principle behind the book. And there were probably 16 chapters and 70, 80, 90 things that we could have written about, but I didn't. I just put 10, 12 chapters in, and we think that there are probably 4 or 5 things that you could adopt, and they'll be different for every single company, that might allow you to, get to the point of 10xing. But maybe it's a 6x. It doesn't work for everybody, and not everybody will get a 10x. Maybe it's a 6x, but 6x is still a lot more than you were probably going to get if you'd not gone down this path. Because what I find with business owners is they're brilliant at their thing. Whatever it is that they're doing that makes money in their company, they're really good at it, but they might not be good on the financial side. They might not be good at, they might not have any idea about mergers and acquisitions. They might not have any idea on some of the marketing. The number of companies that I see that have a website, for example, on the basis that, build the website and people will find us, is staggering. And it doesn't, they don't think in terms of necessarily driving traffic to the website, that then facilitates businesses or business opportunity and sales, or they don't think about retargeting people that come to the website. So you'll see something like a Facebook pixel that is a good way to retarget from people that come to a website, and a lot of companies don't have it. Now, there's sometimes really good reason why they wouldn't, because they're not in a market which is conducive to people finding them from Facebook. But but in a lot of instances, they're quick and easy wins. So you can normally look at a set of accounts and see where you might save some cash. And that might be through outsourcing, for example. You'd still be amazed at how many people do not do that. And then where you can make some money. And I can normally look at the two and see a bit of an uplift in there. So that's why I wrote the book, because I just wanted to help as many people as I could without having, because mine is not a scalable business, Judy. We can only work with 6 to 10 clients. And so how was I going to help other people?
So I was interested in the income side. So let's just focus, because I know there's sort of 3 steps that we're going to sort of look at today, which is the growth of the income, the savings of the costs effectively, and then also a bit about this personal tax planning that you were sort of mentioned at the beginning. So you just touched on it there, I suppose, in terms of the website traffic. I suppose sometimes people they're always just keep increasing prices, or they're always trying to go out to market. And to be honest, I've probably been a bit guilty of this sometimes myself in my own business, because we all rush and we don't always sit back and take a look at what we've got. But I think what you're going towards there is the opportunities in a business to increase the sales, I suppose, with less minimal effort, effectively. So what type of things do you recommend to people if they want to try and sort of increase their sales to people that are maybe currently in their network, what they might not be thinking about? What type of things would they look at?
Yeah, so I'm going to slightly rephrase it. So I start from the perspective of what would be the multiplier generically that you might apply to a value of your business now. And so roughly what I use is, if you're less than $1 million in profit, your multiplier is going to be 3 or less. Now, of course, in some industries and sectors, the multipliers will be more. And if you're selling to private equity, the multipliers might be more. But just as a rough and tough, 3 or less under $1 million in profit, EBITDA, and then 3 to 7 between 1 and 3 million in EBITDA. And then if you're over 3 million in EBITDA, it can be more again. And then I also think about who is the potential buyer. First of all, you're looking at trade sale rather than strategic, but trade sale. So a much bigger company that would buy you. And then you're looking at what kind of trade sale. Is it a private company trade sale or is it a publicly listed company trade sale? Because the multiples that you'll get in the first scenario of a trade sale privately to a public trade sale are fundamentally really different. And the bigger but you've got to move the dial for those organizations for them to be interested in wanting to buy you. So that's why you're going to collect together for more EBITDA. Now, to bring back in what you said, how do you go about it? If you're less than 3 in a multiple for being less than $1 million in EBITDA, it's about what is the most expedient way to get you to 1.5 million or 1.2 million or 1.7 million in EBITDA, so you can make the jump from a 3 or less multiple to a 6, between 3 and 6 or 3 and 7 multiple. And that would be a combination of these 3 core things primarily. One, we normally start with what can we do to save money first, because it's a quick win and the money that you save can be redeployed into growth. Now, areas that I would look at, immediately are where can we look to outsource tasks from a high cost location to a low cost location without compromising on the skill set. Now, a lot of people go, well, we can't do that. It's too difficult. Our standard operating procedures are all baked in and there's real value in those people. And sometimes that's true. But actually, if you look at an onboarding process of bringing in new employees and training them up in your way of doing things, and you come at it from that point of view, it's not as difficult to do as you would think, but it does take time and it's a bit of a commitment. So as an example of that, one of our clients had a number of positions, and this is a bit more unusual, inside basically back office tasks at over 100,000 a year. We outsourced 30 of those positions to a team half the size and saved them 3 million on their top line. Now that is a poke in the eye example, because you're not going to get too many of those. The order of magnitude of savings will be a bit less, but that's only on 10 positions. So imagine that you had 15 or 20 of these that you could do. Now, the smaller the business, the less likely that is. There are positions that you can't outsource if they're customer facing on site with clients, doctors, nurses, these kinds of things, harder to outsource those. So I'm not talking about that. I'm talking about the more traditional areas. And there is still so much low hanging fruit in how you can save money. That alone, as in the example that I've just given you, can save up to 70% on your employee costs.
So as a small business, I've done it myself in my own business. We've probably shaved, so we did an acquisition and was probably slightly overstaffed. And we've done exactly what you've said. We've split our resource. We do have an offshore team now. It did take us 6 to 9 months to implement it. It's going really well now, but it did probably take us 6 months to implement it. But there's been a mix of things we've done. We've changed that. We've managed to, by the mix of different clients, we've consolidated insurances to reduce. So probably in total across the savings, I think we've saved nearly 5,000 a month now in overheads over the last 4 months, as an example. And obviously that's quite a lot because we're a lot smaller than a multi-million business. But for us, that's a massive saving.
But it's still a massive significance. So if you look at $5,000 a month, that is 10, 12, what's that? 50, 60,000 a year on your bottom. If you do nothing else, and that goes to the bottom line, then in your industry, I'm not sure what your multiples are. Is it between 1 and 1.5, something like that? No, so you've just effectively put 100 grand's worth of value on your business, ish.
Yeah,
not that you're selling.
Yeah,
not right.
No,
ish.
No, we're not. No, but yeah,
that's your first step. Now, what they did with that cash was employ more salespeople. So with 3 million, employing salespeople at a cost of 200 grand if they hit target is 2 million of that money ish. I'm rough and tough on the numbers. But those salespeople costing 200 are bringing in 5-6 million to the business if they hit target. I'm not sure what their target setting is. We don't do that bit for them, but they're bringing a lot more into the top line, which then puts more profit on the bottom line, right? And so it's a compounding effect. So if we can help save money first, it makes the cost of investment on the marketing side, and now I'm going to come and answer your question, cost neutral, because you can use that money to deploy marketing. Now, marketing is a big area. You've got the social media channels, all of them. You've got video-based marketing, so you've got your Twitters, your YouTube, your TikTok, your LinkedIn, and we post as a smaller business to all of them. And what we've seen, just because we weren't sure what was going to come back, and you get a very different reaction to your outbound messaging and your outbound marketing. Our kind of posting slightly different. It's more tips and tricks to help people on shorts than anything else. So there's that, but then there's the written side of it and the blog side of it. But there is not enough being done in most businesses relative to what they could do cost effectively to get their message out. And let's face it, the likes of Facebook, YouTube, TikTok, whether you like them or not, they are free distribution channels to get your message out to your local community. And marketing's never been cheaper, providing you're willing to put the time and effort into doing that. Now, when it comes to video, I totally get that not everybody wants to get in front of a camera. It took me 4 years to push record and get over myself, and now I can't shut up. But I understand that, but it's an important dynamic to overcome that helps you pull in more people that you have an opportunity to sell to. Now, you'll need your landing, but it's not as simple as that. You then obviously need landing pages and sales funnels so that you can step these people through a process where some of them will drop out and be nurtured over a period of time, because some people will be 4 or 5 years watching you, depending on your industry, before they do business with you, but you still want to nurture them. And some people will come in and they'll be ready to do business with you much quicker, but they want that social proof. They want that funnel. They want that offer that captures them in. So I'm not suggesting in that scenario that the companies do that themselves. What we do with them is we bring in the right expertise from a marketing agency point of view, specifically with the skill set that we're going to start with, to then use the money that we've saved to get the right campaigns in to deploy those for growth. Now, I didn't mention email marketing, but if you've got a big list, email is still one of the highest returns on investment that you can get. But there are different ways in which you can do email marketing. There's been a lot of change in that in the last year because of the changes that Yahoo and Google have made, which I think are for the better for sure. But it's just traffic doesn't flow. And with traffic isn't flowing, you're leaving money on the table. And these are some quick fixes that you can deploy to start to pulling money in. Even SEO based, which is a longer term strategy, pays dividends in terms of people being able to find you when they're searching in this general area. Now, there's going to be variations. Some businesses are very local. If you're doing this for a meat and poultry business, for example, who's doing 12 million a year, predominantly in the south of England, of course, it's going to be regionalized. And if you're doing this because you're a B2C, more global Kim Kardashian kind of stuff, that's a whole different kettle of fish. But the principle is the same. By better utilization of this and bringing the right skills to the table, which we have relationships when we're doing this with clients in the States and in the UK to do that, you're still using different agencies for different tasks because they tend to have a predominant skill set in a slice of what is the overall marketing piece. Mm-hmm. So that's how we do that.
What you say really resonates with like my own journey, because just a brief background. So I've officially started left my job and started Wilkinson's in Jan 2020. So we obviously know what happened in March 2020, don't we? So I had no online presence, literally nothing. I had some platforms, I had them set up, but I had nothing. So what I did that year is I invested quite heavily in sales development, sales coaching and LinkedIn training. So I decided to start my journey on LinkedIn. Yeah, I probably invested, because I had done some contracting and I'd been thinking about this. I'd saved up some money, knowing that I'd need to invest some money into the business. So I probably spent 10 to 15,000 in the first year on sort of my own personal development to learn my own. It probably took me 18 months, really, I'd say, to really define what I wanted to offer and get good traction on LinkedIn. So obviously now I've got nearly 10,000 followers. And what I did was I stuck to one platform at a time. So I did this, stuck to one platform at a time. And then once I'd got LinkedIn running, we then set up the SEO. So we then brought the SEO advisor in. They've now built our platform. We're on page one, a lot of the key searches now. Now I've developed into the podcast. So I have my podcast specialist that does the podcast channel, which I paid to do that. I then did what you said. When we outsource and save some money, we've now brought in our internal. We have a social media she's a part-time sort of PA. She manages all our CRM tool. So we have our CRM management. And now that we've got SEO and LinkedIn, we've now brought on an advisor to start working on Instagram and those channels. So sort of everything you said really resonates, because I kind of had in summary, that was our sort of standard journey. Don't get me wrong, we've probably used a few advisors that haven't worked out, and we've tried some marketing that hasn't worked. But I think the biggest issue that people don't track, the biggest issue is I speak to so many people that always say to me, oh, I spend thousands on marketing. Oh, but we don't expect it to work. I've actually had those conversations, and I'm like, well, why do you carry on doing it then? Why are you not? Because changing something is harder, I think, than accepting it's not working.
Yeah, I think the whole thing on marketing is it is continual change. And what I love about your journey and what you're doing, Julie, is you've gone one thing, got good at it, added another, and I've gone a different route. I've gone omni-channel from day one. So I absolutely know that we're not optimized on any of the channels, but I'm still getting messaging out. So we get something like 25,000 impressions a week on LinkedIn.
Oh, wow.
And a similar number of impressions on Facebook. Now, engagement that leads to business, I'm not tracking that quite so heavily because for me, it's about getting the information out, and that's actually beginning a personal brand. Now, a personal brand is really important. I've been one of these people for years that have made the huge mistake of the company. But people don't work like that now. You're going to pull in so much more business to your business because of you, because you're personable, because you've got a podcast channel, because people can get to know you and they resonate with what you're saying and they say, this lady makes sense. Let's have a further discussion. And many people would just never find you if you didn't do this. But it's about building a connection with you as a person and building that brand as well as the business. You look at the biggest companies in the world, Facebook, Apple, Tesla, right? You don't think of the brands, you think of Tim Cook, you think of Mark Zuckerberg, you think of Elon Musk. We kind of identify and interact. So even for smaller businesses, there will be massive resistance to getting behind the camera. But for those people that will do that, they will differentiate themselves and pick up market share, I believe. And that's another strategy to 10xing what goes in your bank. And the piece that we didn't talk about was acquisitions. It's absolutely the case. So you've got some limitations on the organic growth side. With everything that we've talked about, you won't double your business potentially in a year. But if you go out and acquire another business, and I know you've done a couple of acquisitions yourself, then you can potentially double your business in an afternoon. Some companies punch well above their weight and they do more than that. But what you then bring in is, the opportunity with that acquisition to eliminate a competitor, cross-sell and upsell, or add more into the overall portfolio, which grows revenue because you've got two different customer bases. But most importantly, you're in an afternoon potentially doubling the top line and the bottom line because you've got another business in the group now. So now, just with those three things, which are, and by the way, it doesn't have to be the case that you write big checks on day one to do an acquisition. Most of the time these days, an acquisition is structured with a much smaller initial payment, sometimes no initial payment coming from your own pocket. And then you're able to structure the payments of the business you're acquiring over a period of time, which makes an awful lot of sense. So it just makes that easier to digest and bring into the business. But surprisingly, there's a lot of business owners, and I was with one yesterday who's running a £35 million business, knows about M&A, he's never done M&A, but thought you had to write a check to buy the business outright. And I went, no, you don't need to do that. So those three things could take you from 500,000 to 2 million, or 1.5 million in profitability. And then coming back to the end in mind, why are you doing this? It's because you've now taken your business from a 3x to a 7x multiple, and you're making it more appealing. Now, there are some other things that we do not do in the beginning. You've got to be cognizant. The bigger you get, the more you need standard operating procedures in play and systems and processes and so on and so forth. We don't do so much of that to start with. We're looking for the much lower hanging fruit, because it's actually going to change your SOPs to a degree when you acquire other businesses.
Yeah, because I understand, because we do a financial controls health check actually for people, because especially in the acquisition stage, because going back to the acquisitions, the reason we did our acquisition was to reduce our risk, because I've only had my business like 4 years fully trading at the minute. And so the first couple of years I sort of did more, I did more consultancy, and we decided to keep the business model. We needed more sort of retainer bread and butter clients, that could, as we started increasing the overheads, we needed the consistent revenue. So the reason we did the acquisition is at that point, we still do the consultancy, but we have dropped the level of consultancy to manage the acquisition in the first year. But the reason we did it is because we thought not necessarily would it double the profit, it's the sales initially, but it'd replace the higher risk in revenue with more retainer, so it lowers the risk so we can cover the overhead. And then the organic stuff comes in because then to maximize the benefit of the staff, we can bring organic clients in because obviously you have to replace, because some companies might close down or go insolvent or whatever, so you have to have an influx. So that was why we did it. But the controls around it, of reviewing that, I find that in a lot of businesses, once they've acquired, they haven't really got an integration strategy. So we often will look at the controls of a business, do a bit of a health check and look at what's the risk elements of those businesses to see, because it's quite important to have the controls around managing the cash flow and things after the acquisitions.
Yeah, totally. And then when you get to that point where you've grown the value, so we've touched on three things there. So there's another of my clients at the moment that's just going into due diligence for the business to be sold. And with this due diligence process has only started in the last 10 days. It's going to go on for, I reckon, 3 months before it's done. But when we started working with them, they were in a bit of a dip because of the pandemic, not because of the recession, but principally because of the pandemic. So their profitability was down around the million mark. So they were getting a valuation of 5. Now, with a number of things that we've done loosely around what we've already discussed, their EBITDA is up to 2.8. And that's given them a multiple of 7.8. So because I'm not good at maths, I'm going to work out 3 times 8 slower than it will take you to work out 2.8 times 7.6 or whatever it is. But roughly their valuation has gone from 5 to 24. Just because of those things, It's taken a couple of years to do. And they've done systems and processes and procedures as well. And in this particular case, the way in which this trade sale will be done will be an MBO. So we're on the inside working with them, and the recruitment of the right people coming in at the right time to help transition the knowledge in the business makes it an easier sale for them, makes it a much easier investment for an outside investor because they see a quality management team in play with systems, processes and procedures and the other things that we spoke about that they've done. So we've not helped them on the systems and processes and procedures. They're well positioned to do that themselves. But we certainly helped on the other areas. And so we've had a partial impact on that 5 to 24. And now they're in the process of selling out the business. And it will be a initial consideration and deferred structure. And that deal I expect to close out probably September, October, finally. But the owners will still be involved. They're going to do a rollover. So in that case, they're going to roll 30% of their holding into the new co because they want the plan for the business is to go again, and now they've got a taste for M&A. They want to do more of it. So in 5 years' time, the hope, if it goes well, is that the existing founders that are selling the business will get a second bite of the cherry and maybe make more money at that point than they're going to make on the first bite of the cherry because the group will be so much bigger. So that's what you can do that so many people, when they start to get to a retirement age, don't think about, and they start really late. If you think that you want to get into a position or at least explore the potential of this in your early 60s, you want to be thinking about it in your middle 50s. But what I've also found, which was a huge surprise to me, is because of the videos I'm doing mainly on Shorts and TikTok and YouTube, I've had a much younger demographic, a 30-something, want to find out more about this. And this is a different conversation. See, when you're at retirement age, you've been through a number of recessions, you've weathered the storm of good times and bad times in business, and you've survived, and you've got a good, solid business that you're in a position to sell. Young people coming through haven't yet been through those cycles of the ups and downs of business. So the kind of questions they're asking are very different, and they're very, very, very brand centric. They understand the value of the brand. Whereas a lot of people that are in the retiring position think less about the brand, they think more about the P&L. And I think you should be thinking about, in today's economy, you're thinking about both equally. You're developing your brand value really well because of the podcast you do that you're fronting. But how many business owners don't do that? And it's more that don't than do, I would say. But young people understand that, and they do more of the brand than on the business in some cases. So, but the questions they're asking are much more about the fundamentals, and they want to take some money off the table because they're thinking, I've done 5 years, 6 years, 7 years of this, and I'm working with a client that's in the drinks industry at the moment, where they've done a brilliant job of getting healthy, nutritious drinks to market, and they're stocked in some really good places. But they want to take a bit of money off the table because they'd like to secure that property they got a mortgage on that they've been struggling to in the early years of the business to A, get a mortgage, and then B, make the payments. Now they can. They just want to take some off to service that so they can go forward. I wasn't expecting that when I was, starting this out. I wrote this book predominantly to help people that are retiring think about ways in which they themselves, through adopting a few tips and tricks from the book that we've been talking about this morning, could cash out and put 10x in their bank account. So once you've done that, a very important part of it is, how would you structure the business to be sold so that you pay no tax or some tax? So in the UK, we've got the tapered entrepreneurs tax relief. So there's 10% on the first million. So you definitely want to be taking advantage of that. And I'm not a tax advisor, by the way, so don't take anything I'm saying as the gospel. You need to talk to your specialist tax advisory people for this. And these are tax advisory people, not necessarily your accountant. You should start with your accountant, but they will often refer you to tax specialists because it's not necessarily their domain of expertise. You've also got EOTs. So, that's a structure where you could potentially exit the business with an interesting valuation, which is normally much higher than an investor valuation, and maybe not pay any tax at all. So those are things. So you've got to basically look at the tax code. Both if you're a US business, look at the tax code for the US, look at the tax code for the UK. If you're a UK business, these are places where I know it works. I think it works in other places as well, but I haven't proved it. But you've got to look at that and say, okay, if I do this and structure it in this way, then I can potentially get significant tax advantages, which may mean you don't pay any tax at all. And that's massive, because if you're paying capital gains or capital gains on the exit of the business, then, that's something that you want to try and keep as much money in your account as you possibly can. So that's your next piece. And then once you've done that, how are you going to protect all that money that you've now got so that and so I'm going to use an example here, which some people might not thank me for, but let me go with it and ask the forgiveness of the audience if they don't like it. But imagine that you've managed to pull in, say, 15 or 20 million into your own bank account now, and you want to protect that going forward, and you know that you won't be here forever. So you might start looking at ways in which you could place those assets into a structure where you don't own it anymore, maybe a trust or something like that. Again, take specialist advice on this. I'm not the expert. But in general terms, I'm pointing in a direction to investigate. So you put it in a structure that can protect the asset. Maybe that's a trust. And then the trustee, there are trustees that manage that trust for the beneficiaries, which might be your kids. And the benefit of this is you're not delaying any tax. You're not paying the tax. You're just delaying it for the life cycle of the trust, which is maybe 120 years away. But the key thing is, while the trust is in the ownership of, while the asset is in the ownership of the trust, should it be the case that your beneficiaries are your children and they get married in the future, but they're beneficiaries of the trust and unfortunately get divorced, that asset is protected because the children don't own it, and so it doesn't have to get divided in two when the happily married couple that are not happily married anymore part ways, and go in their separate directions. I know that's going to be slightly contentious in the way that I put it, but it's a very real thing that happens. And so the three stages of it are 10x the value of it. How do you cash out tax-free? And there are other ways in which you can structure yourself to cash out tax-free that we can help you with the network of people that we work with. And then how do you keep that asset so that, you've got it to enjoy for the rest of your life, and that your legacy for your children, let's say, or whoever is important to you, can enjoy it without having to worry about it as well. So those kind of things. And people don't think about this. And so I'm not talking in this book about anything that isn't already out there in the public domain. What I have done is find a way to bring it all together in one vertical conversational skill stack, if you want, that say, okay, if I go down the traditional path of selling my business and paying the tax, I'm actually going to get very much back for my business. So, if you were going to if you're selling a business today and you get 750,000 for it, Julie, what tax are you going to pay on the sale of that business? That's a question.
Don't start asking me complicated tax questions in the morning.
Well, let's say you're going to pay 25, 26%, whatever it is. You've just dropped a couple of $100,000. That means the net that you get isn't very much, and that's a big challenge.
Yeah.
And so a lot of people need an amount of money for the sale of their business because they need to retire, and that's the amount of money they need. So when you can structure it in a way that where you don't have to pay that tax, or you pay much less tax, why wouldn't you do it? But a lot of people don't think about it or aren't aware of it. So that's why I wrote the book, because I can't go out and work with everybody. We can only work with 6 to a dozen at a time. But I can write a book in the hope that some people get it, and it does sort of help them out.
Yeah. So I just want to thank you, Mark, for coming on to the podcast. It's been really insightful. And I definitely think that planning stage of how people can cash out is something you are right. People aren't thinking about. So I definitely think there's a lot of value to come from what you've given us today. And obviously there's a book. And just going on to the book, I know that you're being very kind and you're offering the listeners to the podcast a copy of the book for free. And I know, so the best way for them to get that is to email you. So if you just want to let everyone know your email address.
Yeah, so I've never done this before, so I didn't come prepared. It was something I just thought about. So you can, if you want, go to Amazon and there's the book. You can get it in Audible, and you can get it as a book and you can buy it. But I wanted to, and it's not expensive. It's like $7 or pounds or something like that. But I wanted to make it available to people that were interested in having it on from this podcast for free. But I wasn't sure how to do it because I don't have an affiliate link for this. I don't want to send you to Amazon because if you do, you'll have to buy it. So we're going to stock some copies. So anybody that would like it, that responds within 2 weeks of it launching and emails me at Marc, M-A-R-C, at acquisitionsforyou.com, then you email me with your that you've listened to the podcast, your name and address and telephone number, and I'll send you out a copy of the book free of charge, including postage. I hope you don't have too many listeners out of Mongolia, because that will cost me a fortune. and can I limit it to, of course, everybody will want 5,000 copies, won't they? But obviously I'm going to send out one copy per person that would like one, if that's okay.
Okay. Well, thanks so much for coming on, Mark. And I just want to say thank you to all our listeners. If you love our show, hit the subscribe button and I'll see you again soon.